Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, there has been a fair amount of chatter around stress that has perhaps crept in retail lending, especially loans that are unsecured, which basically means that they're not backed by collateral. These could be, for instance, credit cards, or they could be personal loans. In fact, the Reserve Bank of India flagged off this trend a few months back, along with tighter regulations for this segment as well. Let's actually first hear out the head of one of the largest banks of the country speak on this subject. Here is a take coming in from Mr. Amitabh Chaudhry, the MD and CEO of Axis Bank.
We also have to be cognizant of the fact that if the regulator continues to keep a tight leash on lending in general, there is a possibility that some of this slippages you're seeing on the unsecured side could flow on the secured side, because they're all linked. And we have to be watchful of that. You've also seen the Indian consumer over-leveraging themselves in some case quite rapidly. So I think that also is getting normalized as we move forward.
Okay, so perhaps we consumers have gone a little overboard, but the regulator is watching and so are banks. So the onus is on us, the borrowers, to be more responsible, to ensure that we don't go overboard and fall into perhaps a debt trap of sorts, and that we make use of credit judiciously to further our financial goals. Now, how do we do that? To answer this question, we have a panel of experts joining in. I have with me in the studios today Frederick Dsouza, business head, credit cards at Kotak Mahindra Bank. Also Bhavesh, Jain, MD and CEO of TransUnion CIBIL. And joining us all the way from Prayagraj is Mr. Ashutosh Khajuria, former executive director at Federal Bank. And of course, he's been a career banker and, has watched these trends unfold over multiple cycles. So, gentlemen, thank you very much for joining in. I want to start with some context setting because, as customers or borrowers or viewers, we've been hearing all these headlines around, stress in unsecured loans, stress in credit cards. You tell us, what do you see around you? And has this meant that there is lesser availability of loans in general for the retail janta out there? Frederick, let me open with you.
Thanks a lot, Surabhi, for having me on your show. It's always a pleasure to be here and learn. No doubt there has been an increase in the risk that we are seeing in our unsecured portfolio in general as an industry, right? And there has been a lot of stuff that the various issuers have done in order to manage either the new issuances or the kind of exposures they take on customers in terms of credit limit programs and things. Yes, but that does not mean that this is, not an opportunity to expand your risk or to get the right kind of customers in. It is more of a phase of responsible borrowing, as you rightly put it. So that's the I would say, the spirit in which banks are operating now.
Fair. So that's why we're here to educate, inform, and to sort of, get people to take charge and take responsibility behind their actions, even if it is taking on that credit card or a loan. Bhavesh, come in on this, and you guys are the holy grail, right? Everybody's talking about their CIBIL score. I think that level of education has happened, that I need to maintain a good credit score, a CIBIL score, right?
Yes.
What have you observed in the last couple of months, the trends around us?
Firstly, thank you so much, Surabhi, for having me on the show. Yes, with the timely regulatory guidance along with the relatively high credit deposit ratios, we have seen a moderation in the retail credit growth. And let me put out some data points. We have seen housing loan decline year on year with a 9% reduction in volume. Credit card, in fact, has declined by 30% year on year in terms of volume originations.
This is as of the June quarter.
Yes, June quarter as compared to 23.
Previous year. Yeah.
Yes. But the interesting thing is that two-wheeler volumes in terms of financing has gone up. And what we see from the CIBIL data is that there are emerging pockets for lenders to tap into these deserving and credit-eligible consumers across different age groups, across different geographies, across different socio-economic categories, which gives an opportunity for the credit institution to go deeper into multiple geographies, bring these consumers into the credit fold.
Sure.
And we see an opportunity for the consumer to reach out to these institutions and get the right terms and conditions.
Yeah.
So we see a win-win opportunity still existing.
Okay, fair enough. Let's bring Mr. Khajuria into the conversation as well. Now, sir, you've been a career banker and you've seen so many of these cycles play out, right? And I guess for a borrower, the temptation will always be there as there is more access to credit. I'll always want to have a fancier car, a better looking house, better clothes. I'll want to go on a big fancy foreign holiday. But where do we begin? How do I determine how much can I leverage myself?
See, I think there should always be a proportion of, what your normal expenses are, which are the ones which are to be met necessarily. And once they are taken out, then one can look at the discretionary spending. And that spending can be substituted by loan, subject to, of course, the cost of borrowing as well. And then multiple borrowings at the same time sometimes create problem for the lenders also to assess. Now we have very good credit bureaus and all sorts of information is available. And therefore, lenders are also becoming more informed before taking a call. But whatever said and done, for a borrower, they definitely must look that they do not fall into debt trap. And debt trap is a situation where it is difficult to service the liabilities. You need to borrow more to service the earlier ones. And that should not happen.
No, absolutely. Frederick, your thoughts on this? And the fact that there's easier availability of credit as well, right? You tell me, I mean, there are fintechs, there are NBFCs. So is it true to an extent that just because it's become easier, one has a propensity to borrow more? And how to guard against that?
I think, fundamentally, when you're thinking about borrowing, I would advise all your viewers and the customers to think about how much of their income can they actually service for either some EMI or any other debt obligation, right? As a rule of thumb, I would recommend, say, 40 to 50% of all your net monthly income should not go into servicing. Beyond that should not go into servicing an EMI, right? And I think when you look at that as a metric, and this is a rule of thumb, right? It varies from individual borrowers. Each of them have their different requirements and financial situations. The other thing I would add is that, like Mr. Khajuria also rightly pointed out, one should understand their income and their expenses also, right? A lot of times, while we get a salary in hand, but really how much of our income is disposable, right? So we have our rent payments to do, education for kids, insurance premiums, and day-to-day expenses, right? And some of the discretionary expenses also not really non-discretionary, right? So to that extent, having a good understanding of your disposable income, ensuring that you do not cross a certain amount of your monthly take-home in debt repayments is something that fundamentally an individual should monitor and govern.
So 50% is the rough cap that you'll go with, that all
As
your
a general
repayments
rule of thumb, yes.
should not be more than 50% of your income. Mr. Khajuria, to come back to this point, weigh in also for people who do have some cash in the bank or in their investments or in their fixed deposits. Sometimes the choice is between breaking that fixed deposit versus taking on a new loan. And that can be a little difficult. What would you guide on this?
Surabhi, I'll slightly differ on that count wherein we fix a particular percentage. There could be a situation where for subsistence itself, the borrower needs to spend almost 75 to 80% of one's income. If that be the situation, then the leeway is very little. Then he has only 20% of income available to him, through which, he has to manage his EMIs, his liabilities. Now, as regards, breaking the FDs and all, it's give and take between, what sort of rate of interest you are having on your existing FDs. If suppose FDs were opened in a cycle where rates of interest were higher and the FDs are continuing, I'll just take some numbers to understand it better. Suppose if you are having a fixed deposit which is running at about, say, 8.5%, and the interest cycle, changes. And now you have, say, this FD is for, say, 5 years, and it has run for 3 years. Now you have a balance tenure of 2 years. But the borrowing is available at lower than the rate of return on FD. Then one should not break, because he has a backup to repay his liabilities. In that situation, it would be advisable to go for a loan.
Okay. All right. Fair enough. So you need to understand which way the borrowing cycle is moving. And we will spend some time doing that in the next couple of minutes as well. But before that, how do institutions decide whether you'll get that loan or not? Obviously, your credit score plays a big part in that. So, Bhavesh, come in on this. We all know that, 700 is that holy grail mark, right? But what happens if someone has a score below that? Are your chances really, considerably reduced then? Tell us more about the credit profile.
Sure. So first, let me take, for your viewers' benefit, few minutes to talk about the CIBIL score. So it ranges from 300 to 900. The closer you are towards 900, which is a reflection of a healthier credit profile. And yes, it does ease up your availability of credit within the country, and the rates of interest, the terms and condition, the speed with which you get loans improves as your score is higher. And to your question around saying that if you have a score below 700, what does it to do to you? So each institution have different score thresholds based upon the type of loan you are seeking, the tenure of the loan you are seeking. Are you looking at an unsecured loan like a credit card or personal loan? Are you looking for a housing loan? But does that mean a low score means end of everything? The answer is no. Because you can make sure that you work on your financials, you continue to pay your loan on time. If you have multiple obligations, you consolidate into one loan. You make sure that you don't max out your credit limits. Then it's important that you don't continuously keep applying for different loans or credit cards across different institutions. And you live within your means. You sort of have a good credit discipline. And over a period of time, you should be able to get back into a healthy score band.
And when you say low score versus healthy score, define the rough ranges that institutions typically go with.
So generally, there are a bulk of institutions who consider 700 and above good. There are bulk of institutions who consider 725 or 750.
Okay.
But between 700 to 900, yes, you will be welcome with a sort of a red carpet.
Okay, so let's ask the bankers then, because obviously the credit score is one criteria. There are lots of other things that will be checked before you get that second credit card or that second personal loan to go over an auto loan that might already be running. So what are those conditions and what all should I be mindful of, especially if I already have a home loan and an auto loan going on?
I think to add to what Bhavesh said, right? See, a score is also something that builds over a period of time, right? So as a bank, we obviously, the fundamental thing is to see the cash flows of the individual, right? So if somebody especially someone has a bank account with you, you have a very good understanding of the relationship, the vintage the customer has with you, right? And you get a lot more information that the kind of transactions they do. And at Kotak, we also use a lot of that information to build scores to underwrite customers. So I would say fundamentally in any lending relationship, understanding the cash flows of the customer is the primary evaluation that you do, right? The second thing you would obviously do is the stability of the income, right? So how many years of employment and things like that, the kind of industry they're working in. There are various parameters you can evaluate and consider while giving a loan, right? Okay. I would say bureau information is very critical, right? In fact, vintage on the bureau also becomes a critical consideration. And frankly, that could also be the reason why your score may not be high enough in the beginning, but over a period of time, you would be getting the red carpet that Bhavesh spoke about.
All right, let's quickly get in Mr. Khajuria to respond to this as well. Mr. Khajuria, is that the lens that typically, all your fellow bankers have always put on, somewhere between 700 and 750? And what happens if you do have a couple of loans and you happen to be below 700? I mean, is that zilch chance? And also tell us if there is a prevailing trend between PSU banks and private sector banks, whether different entities look at it differently, if there are any sector trends.
So I agree with my fellow banker on the panel. Yes, we do look at cash flows, but I would go a step ahead and say the trend of cash flows also is very important. As to somebody is having a rise in his salary, say about 15-20% every year, and that is happening for the last 3-4 years, I think a fair guess can be made as to what his cash flow is likely to be. And then with the, while discussing with the customer, normally in personal loans and credit cards, you go, mainly buy the scorecards and all, and there is a lesser sort of occurrence of the interaction, one-on-one interaction with the borrower. But wherever it happens, I think we try to understand as a banker as to, is there any addition to the number of his dependables? And as rightly said by Bhavesh, more a borrower tries to shop around and applies to various, credit cards and all, his score gets impacted because that gets reported as to so many inquiries were there. So I think cash flows are very, very important. And it's not limited to only credit cards and personal loans or other retail loans. It's also very, very important for other segments of lending, including the corporate bank.
No, absolutely. Bhavesh, just to complete this point, so just clarify this for us. Even if someone goes to inquire around for a loan and multiple loans, that means the credit score and the profile is going to be impacted?
Okay, let me explain it for the benefit of the viewers, that if you go and seek information from different credit institutions, it does not impact. But if you apply to 5 banks or NBFCs seeking a loan or a credit card, which means you are seeking credit at the same time for multiple institutions. There's a difference between seeking information versus seeking credit. When you seek credit from multiple institutions, yes, it sort of impacts your score to some extent.
Okay.
But at the same time, if you come on to any of the websites, including CIBIL.com, and pull your own report, as an individual, it does not impact your score.
Because you're just checking where you stand.
Exactly.
So one more question on this. A person having 4 outstanding, personal loans or credit cards or home loan, auto loan, versus someone with just 1 outstanding loan, say a home loan. The guy with the 4 loans will have a lower credit profile or a lower credit score. Is that a, general way of looking at it?
So I would say the most important aspect here is the repayment behavior.
Okay.
Whether an individual has 1 loan or 3 loans, the most important aspect is this individual paying it on time or not? That's the biggest deciding factor.
Got it. So it's not the number of loans, but how are you servicing those loans? That determines the credit profile and the credit score that you are going to keep. Okay, we need to take a very quick break. On that note, this is a very interesting conversation. On the other side, we talk about how you can use a falling interest rate cycle to improve your credit history, to perhaps repay off some loans. How do you do that? Discuss this after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are putting the spotlight on how one can borrow responsibly to avoid a debt trap and yet to achieve your financial goals. Well, we have a panel of experts with us. And the fact is that this year is supposed to be the year when the Reserve Bank of India starts lowering interest rates. So if we are indeed going to be in a falling interest rate regime, then how can we utilize this time to perhaps take on the right kind of loans, repay some of the old loans, and improve our debt profile? Mr. Khajuria, that question for you. Help us out over here.
So I think in a falling interest rate scenario, which is likely to come, that's what the expectation is. If the inflation is reined in, then there is a likelihood of policy rate being cut by the central bank. In such a scenario, I think for retail borrowers, there's already good news, and that is that RBI wants all the banks to lend to retail borrowers only against an external benchmark. So it is not their internal benchmark through which customer may feel little, cheated or so. It's a very transparent one. External benchmarks could be, repo rate, which is the policy signaling rate, or it could be a treasury bill rate, or it could be a certificate of deposit rate. Now, when the interest rate is expected to fall, assuming that repo rate, which is currently at say 6.5%, is likely to move to say 5.5%, 1% cut, then I think the new underwriting, when it happens, borrowers should ask for, or rather request for, a floating rate interest, so that whenever repo rate falls, their effective interest rate would go down. Suppose today it is, say, repo rate plus, say, 2%. So that means it is at 8.5%, 6.5 plus 2, 8.5%. And assuming that repo rate is cut by, say, 25 basis points, then repo rate becomes 6.25. At that time, the effective interest rate for the borrower would automatically become 8.25%, and so on and so forth. Suppose if the fall is of 100 basis points, the borrower would be benefited by a lower rate of interest of at least 100 basis points. Now, this is one part. Second is, the lenders may ask for, fixed interest rates, or maybe earlier contracts would have been there at fixed rates of interest. Now, assuming that interest rate is going to fall, and therefore the earlier loan is assumed to be, or is believed to be, a costlier one, borrowers can reach out to their lenders and say, we want to prepay our loan. subject to the prepayment penalty and all those things. In case you are making payment from your own resources, from your own cash flows, and not doing the balance transfer, even regulator permits that without penalty. So in such a scenario, borrowers should go in for making prepayment of fixed rate of interest loans.
Okay, get the fixed rate out of the way, fixed loan out of the way, and move to a floating rate if the rate environment is going to become a little more benign. Got that, sir? So very quickly, gentlemen, down to the final thoughts and the checklist. Frederick, why don't you take it up again? Just again, the hygiene factors that we must keep in mind to ensure that we are not getting into a debt trap and not over-leveraging where we can't service the loans.
I think the starting point for any customer should be the long-term financial goals, right? They have to keep in mind that they're saving enough and investing in the right place, right? An understanding of your disposable income, right? Like we discussed earlier in the discussion too, exactly how much do you have available with you to pay your EMIs, right? While we spoke of rule of thumbs, but each individual is unique, right? So having that clear understanding, what are your fixed obligations every month, and therefore what is it that you have available to pay? And Bhavesh also rightly pointed out that it's the repayment that matters, right? So I would say these are two very critical considerations, and then figuring out exactly, what could be your exigency fund requirements.
Right.
So at times you may need a certain cushion of cash with you for whatever exigencies you may have, or even a foreseeable long expense coming down the line, right? It could be even a holiday, right? So having that financial soundness and understanding of your disposable income is very critical before you take a fresh loan. I think add to that, when it comes to being more responsible with the loans that you have, not missing your payments is holy grail, right? It doesn't go, it goes without saying, right? I would actually encourage, we do it for our customers, and I would encourage the viewers to actively track their CIBIL score also. It's freely available. Even TransUnion offers it to customers on their website, right? So please keep track of your CIBIL score, because once it's like, once you know a metric and you're tracking it, then you want to make it look good.
No, absolutely. And, just to finally, come down to even those who are stressed, because we are in an environment where people who are watching this could be facing, challenges in servicing loans. Bhavesh, any sort of way out or any tips you'd like to leave them with? Where can they seek help, and how should they try and sort of, get out of that situation?
So keep it simple. I would say that if you have multiple loans, credit cards, do a simple consolidation, keep bare minimum number of financial obligation, continue to pay on time, don't apply for additional new loans across multiple institutions, and keep monitoring your credit report and your credit score, because that's a reflection of your financial health.
Okay. All right, gentlemen. This was a helpful conversation, and hopefully the takeaways will help our viewers and, of course, your borrowers to borrow more judiciously and responsibly. Thank you very much for sharing some insights. Well, with that, we're out of time, so it's a wrap on this week's edition of Let's Talk Money. Keep sending us your feedback, comments, queries, and questions. We'll see you again next week.
Let's Talk Money